in this kind of consolidation and in this kind of sideways move. So you can see that the volume dries up by just, again, using a common sense approach and looking at the bars. Are the bars big or are the bars small? Here we have small bars, so, again, about 15 pip range here. So we can automatically equate that to a small volume. There we go. Now, if a market maker is going to try any of his shenanigans, pushing the price around, taking out stops, doing things like that, it's going to be during one of these very small bar times where there's just not a whole lot going on. Let me go ahead. Bear with me. That didn't come out very good. Let me turn off my magnet. There. I apologize. I've got the screen minimized to make sure that everybody can see it. So you can see here, there's a 25 pip line. So you can see just how small these bars are. But let me give you another comparison. There we go. You see this 25 pips, how just one of these hours is about 25 pips, okay, from high to low, okay? High to low, just a little bit more than 25. You can see this one was just about exactly 25. So it gives you some perspective, okay? So if a market maker is going to move the market, they're going to have to spend some money to do that if it's more than about 5 or 6 pips. So during these low volume times is when the market maker can start to move the market. And let me try and give you another example of why that may happen. Okay? If we are looking at the market as if we were market makers, okay, here's one example of some of the market maker incentive to push the market around. And let's say the market is trading back here. Okay, the market is spiked up and it's trading pretty high. The market starts to back off, and now we're looking at the market trading in this range here. Okay, so the market has moved up to this point and then moved down to this point. And we can see that we've got a big order to sell over here. We'll say 100 lots. I'm sorry, a big order to buy of 100 lots. And then another larger order below that of 500 lots. But then we notice that to sell, we've just got little stuff, 20 lots, 10 lots, another 10, another 10, and then when we get up here, now we start getting into 300, 400, 1,000. Okay, so you see how there's a gap here? There's a lull in the selling. We've only got 20, then 10, 10, 10, then all of a sudden 300, 400. Now, you got to follow me here. Now, if you remember from the last time, we were talking about selling a house, okay? If you're selling your house for $200,000, and you see that there are another couple of properties on the market for about the same price, but they're all right about $200,000. And those houses go up for sale, and they get sold. So yours is the only house on the market. But then you get wind of a couple of people that are looking to sell, and they have to sell. So one guy, he says, man, I'll sell for $150,000 because that's what I owe. And another guy says, shoot, I'll sell for $140,000 because that's what I owe. We just got to get out. But then, using the example from the last time, you know that there's a Home Depot coming into town. It's going to be right across the street. So all of a sudden, you're going to have a bunch of people offering to buy your property for $500,000, maybe even $600,000. Okay? So you see this gap. Well, now, wouldn't it be a good idea to go down here and try and buy these two properties? Well, haven't you, in essence, moved the market from $200,000 down to $150,000, down to $140,000? Well, yeah, you have, because if you really think about it, and this is something my wife and I are actually